Hi everyone, how are you doing? Welcome to our lecture on Chapter 12. We're going to be talking about intangible assets today, and so I'm going to get started on that here pretty quickly. I do want to point out this event, depending on when you're watching this. I'm recording this on the 23rd of January. If you're watching this on the 25th of January 2021 here, you want to make sure that you register for this event. Come to this event, gives you some discussion about the process for your CPA, including education, experience requirements, and we're lucky enough to have the California State Board of Accountancy president come and talk to us about that. Nancy Corrigan, you can see her picture there. And if you click up here, you can register for the event. You need to register because we're going to send out the Zoom link day of event. So look for that email. If you've registered for that, you'll get the Zoom link. You'll be able to click in 6 to 7:30. What you need to do when you join the event to get 5 points extra credit that I'm going to give you for that is take a selfie with your picture frame up on your computer screen. Take that selfie, and then you will be able to upload that, and I'll show you where, into e-learning, and I'll give you 5 points extra credit for attending that event. Okay, so be aware of that. It's a good event. Not only are they going to be talking about the technical aspects, but also the opportunities, the values associated with the CPA. And we're going to have some guest speakers from Moss Adams, which is one of the big accounting firms that does recruit pretty extensively from GGU. So you may want to come in and learn. They're going to talk a little bit about how to apply for positions with them. You might want to take down their contact information, establish a contact that way. So good event, I think, 6 to 7:30, Monday, this coming the 25th, okay? Just going into e-learning for our class, okay? And taking a look, we are going to be right here going through these slides for Chapter 12, okay? I'm gonna open those up, and we're going to go through those. I've gotten a couple of emails. I know when we're first getting started, how does the class work exactly? Again, I've said this in other videos, lectures, and the introduction video, welcome video is definitely something you need to be spending some time with. But for these week-to-week chapters, okay, slides, download those, either print them or have them available on your tablet or something so you can mark it up as we go along. As you've seen in these lectures, I mark them up, okay? I have the slides, right? I have the lectures. I have the practice midterm. I then walk through the practice midterm with you. Practice midterms, guys, are the best indication of how you're going to be tested on this material. As I go through the lecture, I do mark up the practice midterm lecture, and as long as Word cooperates with me, because it loses its mind a little bit when you go to save a file that has all kinds of inking on it. Sometimes Word can't handle that for some reason, and it crashes, and then I'm not able to save it. But as long as the system cooperates with me, I will post those up, okay? That's the best way to prepare for your exam. I'm going to say it again. That is the best way to make sure you're tracking with how we're learning the material and how we're ultimately going to be tested on this material. Okay. Homework is in Wiley Plus, and I just want you to go in and swim around in the homework. I don't know a better way to put it. You know, try it out, test drive it, a little extra practice, okay? I'm not going to critically grade the homework. I'm not going to be sitting there week to week saying, well, you haven't turned it in, what's wrong with you? You know, I'm going to be awarding the points. It's 1 point per chapter at the end of the semester, and as long as I don't indicate and I'll probably be looking to see how you did in the homework like after the first midterm, and I might make you a little uncomfortable saying, well, gee, you didn't do as well in the midterm, you might want to try some more of those homework questions. But as long as you've given it some attention, some effort, that's fine, okay? I did post the solutions at the request of one student to all of the homework solutions that are in there in the book. Although in Wiley Plus, I've given you 100 questions per chapter. I don't expect you to work 100 questions. That's all Wiley will let me give you. And so I want you to get the full leverage of your Wiley Plus access and be able to swim around in as many of those questions as possible. And I've given you the homework solutions, so you could also turn to the back of your text, pick a particular homework question you think you might want to give a try, do it, and then the solution is there for you if you get stuck in the middle or something or want to check your work after. That's it. I mean, that's the class, guys. I'm not a threaded discussion guy. I want you to spend your time watching these lectures, getting comfortable with the materials. We go through it together. The practice midterms, we go through it together, okay? And then you know where I am. If you have some additional questions, you need to reach out, okay? So we're going to go through the chapter 12 slides today. I heard a comment from a course development person. Don't make the videos too long. If you make the video too long, nobody's going to watch the video. And make your videos 10 minutes, okay? I'm going through all the slides with you. It's like a lecture in class. If you get tired, you see me, I get tired of hearing my own voice sometimes, so I'll sit there and say, hey guys, I'm going to take a break, and I got to go for a walk or something, get away from, this droning on about something that, nobody wakes up in the morning and says, oh boy, I can't wait to talk about intangible assets. I mean, I do, but you don't necessarily wake up in the morning saying, gee, I can't wait to hear about that. I get it. Pause the video, stop the video, look at where you stopped, and come back and pick up where you left off at what seems like a natural breaking point for you. In fact, maybe the point where I say, hey, I'm going to take a break. You take a break at that point, although, if you just let the video roll, I'd be right back because I paused the recording. You get it. Okay, guys? So make it work however you feel comfortable watching those videos, but do watch them, okay? All right, so what I want to do then is open up my chapter 12 slides, and hopefully I got them somewhere nearby. Looks like that's them. Okay, so let's see if they let me open it without any consternation here. Okay, put it in slideshow. Let me put my computer in tablet mode and okay, good, guys. So we're going to go ahead and we are going to jump ourselves into chapter 12 slides. You saw where to get those, so hopefully you have those downloaded. And let's go ahead and take a look at chapter 12, intangible assets. Okay, now in chapter 10, chapter 11, we talked about fixed assets, and we talked about the depreciation methods for those fixed assets. Fixed assets being property, plant, and equipment, okay? Well, what we're going to be looking at here is something called intangible assets. And, the topics that we're going to get into, you're not having deja vu if you say, well, I thought we kind of talked about that for our fixed assets, okay? So we're talking about valuation, and then when we talk about the decreasing value over time of an intangible asset, instead of calling that depreciation, we call it amortization. Different word, same general principle. As the value of that asset decreases over time, we take not depreciation like we do for our plant and equipment. We don't depreciate land. We call it amortization when we're talking about an intangible asset. Okay. Now we're going to talk about the different types of intangible assets, because depending on the nature of that intangible, we will see that there are slightly different amortization rules around that. Okay. We will talk about recording goodwill a little bit. When you record goodwill, it really only comes on the books in the context of a consolidation. And we're going to wait till we get you into advanced accounting to really get you into consolidation and really sink you into all the aspects of goodwill calculation at that time. However, it's worth our time to go ahead and talk to you a little bit about that in here, and we'll get into that. Okay. Presentation requirements for intangible assets. And then akin to the notion of intangible asset is this idea of research and development costs. How do you develop something like a patent? How do you develop something like goodwill? And we're going to see that the cost of developing those things is generally expensed. The only time we capitalize the cost of, say, goodwill, a patent, is when we purchase it from whoever developed it. Then it comes on the books as an asset and gets, in some cases, would get amortized over time. Okay. All right. So that's where we're going to be going with our topics. And so let's go ahead and take a look. And here they talk about that intangible assets. Okay. Why do we have to have a different discussion for an intangible asset versus property, plant, and equipment versus a what? A physical type asset. Okay. So let's take a look at this. Okay. It says it lacks physical existence. So let's pretend we're talking to a caveman. And we say to the caveman, would you rather have this building, this house, right? If they're living in a cave, you show them a nice house. Would you rather live in this house, or would you rather have this piece of paper that allows you to have exclusive right to the production of cell phones? Okay. Now, a caveman who is focused on what? On the physical nature of things, right? Is going to say, oh, I want the house. The house, I can stay inside. I won't get rained on. Give me the house, right? Meanwhile, because they're not as sophisticated, they don't realize that that piece of paper that gives them the right to develop this and the exclusive right to develop this, say a patent, well, that is infinitely, as you're well aware, more valuable than just one house, right? Okay, so intangible assets, the value is not so much from what you can see, obviously from their physical existence, to what they can do for you, versus what? Versus the right that comes with a copyright, the right that comes with a patent, the benefits of something like goodwill. Okay. All right. So it's not a financial instrument either. It doesn't really have physical existence. Now, what are some things that are similar to other assets? Well, it's an asset, meaning it has future economic benefit. I have the right to produce this phone. Nobody else can produce this type of phone. So I have what? I have future economic benefit. Okay, so in those regards, it's like an asset. We're going to see what? It's like a fixed, it is an asset. It's like a fixed asset in that it has future economic benefit. What else? That value necessarily will not last indefinitely. Okay, we may actually know how long that value is going to last. So over time, that value will decrease. So we don't call it depreciation, we call it amortization. But the thought process is very similar to what we said about fixed assets. Okay, so not a really difficult concept. Kind of fun to think about the nature of intangible assets, etc., as we get through this. One more important difference from a physical asset. If I'm an entity and I spend money to construct a physical asset, as I spend that money, I capitalize that cost. In other words, I debit an asset account and report it on the balance sheet, and then I start amortizing. And in fact, last time we even talked about if you have to borrow money, you can capitalize the interest cost associated with the development of that physical asset, right? Okay. For an intangible, very important, you can't capitalize the cost of developing an intangible asset. So as I'm developing the research, if I'm expending money on the research and development to eventually allow me to patent the ability to do this, I can't capitalize that. I debit expense. I debit research and development expense as I go through that process. Now, if you come around and you say, hey, John, I want to buy that patent from you, Well, now, because you have created a perceived value there as the purchaser, you can go and you can debit asset when you acquire that. Okay, so any cost to develop an intangible, right? Nordstrom, I like to use in my example all the time. They spend all this money on training to make sure that their employees are very nice to you when you bring back a pair of shoes that you've been wearing for a couple of months because you realize they're not for you, whatever, and they smile. Meanwhile, they're thinking, oh gosh, this person looked like they ran 10 miles in these shoes. Why are they bringing them back, right? They bring them back with a smile, etc. I had a friend that worked for Nordstrom. She told me, yeah, they tell us that we have to do the return with as much enthusiasm as we did with the sale, right? Okay. And so they do all that training. You say, well, that's developing goodwill. That has future economic benefit because now people will come to Nordstrom every time they want to buy shoes. That's an asset. Nope. FASB says, no, you will expense all research and development cost to internally develop a patent, goodwill, that sort of thing. Now, if someone comes around and acquires Nordstrom and pays more than the fair market value of all their other net assets, then in that situation, now that additional amount that they paid is perceived as goodwill, and the purchaser of Nordstrom can capitalize that goodwill. The purchaser of the patent can capitalize the cost of the patent. Okay? All right, so that's kind of where we're going here. We're just sort of distinguishing here the difference between, a fixed asset like property, plant, equipment, and these intangible assets. Okay? All right, so let's go ahead and let's start to take a look at some of the characteristics and type of intangible assets. And I've mentioned patents. Okay, I've mentioned copyrights. Don't you wish you had the right to all of Beyonce's songs? Okay, all of the different artists today, and I'm struggling because I don't want to start mentioning things from my point in time, that you've never, who's the Beatles, right? Don't you wish you had the right to all the Beatles songs, that sort of thing, right? Okay, franchise license. There's obviously benefit to the fact that you can hang up a sign that says, hey, we're McDonald's, come on in, right? Little kids, every time you're with a little kid, you drive past a McDonald's sign, you got to stop, right, and get them some French fries or something. Okay, trademarks, trade names. Okay, I'm wearing one right now, guys. I hope you don't mind. Okay, and then what? And goodwill, as we've mentioned, that can be built up over time. And someone would be willing to pay more than the fair market value of all my net assets to acquire what? What are they acquiring? They're acquiring a notion, an idea that this is a good company that I've built up over time. Okay. Now, notice they mentioned down here Coca-Cola company success comes from the secret formula for making Coca-Cola, not its plant facilities, right? So someone's willing to pay more for Coca-Cola than what? Than all of the value of the net assets, because part of what they would acquire, I guess, is the secret formula from making Coca-Cola, I guess, disregarding the obvious health problems with drinking high sugar drinks. Okay, but anyway, now look, let's use this as a good example though. Coca-Cola used to put cocaine in their product. Okay, that's how they got the name Coke. I don't think they do that anymore. In fact, I know they don't, because the Drug Enforcement Agency would want to have a word with them if they did. So they don't do that anymore. Okay, but they put all this effort into developing this product and this secret formula, etc. Whatever they spent to develop that secret formula, that's expensed. Coca-Cola does not capitalize the cost of developing that secret formula. What they would do, though, is if they turn around and they sell you everything, including, and why would you buy it unless they gave you the formula, including the secret formula, and you're paying more than the obvious fair value of those obvious physical assets, the fixed assets, if you're paying more than the net fair value, the fair value of the net assets minus liabilities, then that amount would be recorded as goodwill, and we'll see the rules of how goodwill works here in a little while. Okay, good. So when we talk about valuation of fixed assets, of intangible assets are purchased. So put down here, right here, again, I want you to take notes as you go along on your slides. If you didn't do that, good idea at this time to go ahead and stop the video and get the slides and mark them up with me as I go along. Purchased intangible, only capitalize cost if acquired from third party. The cost of developing an intangible, that is going to be expensed. But if you acquire that from a third party, capitalize, record on the balance sheet. Get used to that term, guys. Capitalize, I know you're probably already familiar with it. Capitalize means record on the balance sheet. Debit an asset account, report on the balance sheet. Credit cash or whatever it is you paid for that. So typical costs include, let's just take a look at the nature of costs associated with acquiring a intangible asset. And I got to switch it to highlighter now. Typical costs include the purchase price. What did you pay for that patent? Any legal fees associated with that. And other incidental expenses, and they shouldn't call it expenses if you're capitalizing it, but other incidental costs. Expense has the word in it expired, like we talked about last time. Expired means the future economic benefit has expired, therefore we report it as an expense on the income statement. Assuming we bought this thing, it still should have some future economic benefit, so any costs other incidental costs, should be expensed. Now, if we sat there and we spent money to develop this intangible, those are expensed. So you come over and you take a look, and internally created intangible. That means that we will expense all costs associated with developing an intangible. So some of the examples I gave you, the Nordstrom spending money on training to develop goodwill, those are expensed. They say recorded at cost. Recorded where? As an expense. On what financial statement? Not the balance sheet. They're reported as a separate line item, research and development expense. Research and development expense is an important line item that analysts will look at on the income statement. So even though US GAAP is saying we have to expense research and development costs, we expense them, even though they're telling us to expense them. If you're an analyst, let's say you're looking at one of Elon Musk's companies, and you see losses. In fact, if you don't believe me, go back and look at Tesla, right? You had periods where they were showing losses period after period. Meanwhile, the stock prices kept going up. And you're like, why would the stock prices keep going up on a company that's suffering losses period after period? Well, the loss was being generated to a large extent by the research and development expense line item on the income statement, and all the analysts knew that research and development expense was going to eventually turn into the patent or whatever for some great product that nobody else could produce, and so that had future economic benefit in the analyst's mind, even though FASB was saying, hey, US GAAP was saying, hey, you got to expense that. So then the obvious logical question is, well, why is US GAAP cause them to expense it if everybody knows that it has future economic benefit? Well, back around the time that they came out, it was one of the early FASB statements. I think it was their second statement. Around the time that they came out with that, they had done that required that you expense all research and development. They did some empirical research at that time, and they found that most research and development does what? Crashes, doesn't turn out. And they weren't comfortable with the potential misinformation, okay, that would be being sent to the investing public if you were capitalizing costs of something that really didn't have future economic benefit. So they made the decision at that point in time that it was better to just go ahead and expense all research and development and let the analysts have a little bit more savvy as to how they look at that particular expense line item. Thus, they require that you have a specific line item. And by the way, FASB does not get too much up in the face of companies and telling them this is exactly how you have to report things on the income statement or the structure of the income statement, right? In this case, they did. They came out and they said, you will put this as a line item on your income statement, research and development. So analysts could tease that number out and look at that maybe different than, say, administrative expenses, which maybe analysts aren't too in love with that kind of an expense, right? Okay, now, we're not going to talk at all about IFRS. IFRS is not nearly as important for our development at this point in time. And so I'm not going to talk too much about that, but as I've said, where I think there's a nice, interesting comparison, I will, okay? So under IFRS, International Financial Reporting Standards, okay, they say that companies should expense the research, but the development can be capitalized. So IFRS took a little bit of a different approach. Now, the reason I think this is interesting is back in the early 2000s, I would go to different, accounting functions and whatnot. You'd sit next to somebody while you're trying to eat, a salad before dinner, and they would say, Mr. Lord, what do you think of the fact that, it's not a question of if, but when the U.S. will go over to IFRS? And I'd be like, well, guys, one time they asked me to go speak before Cal State, LA about IFRS, and they were cornering me, about what did I think, because they knew that I worked for the GAO, for the Government Accountability Office. Congress, where's Congress on this? And I pointed out to them, guys, our system, when people would ask me that, our system doesn't work that way. Our system is one of 3 different departments that balance each other. The Security Exchange Commission is part of the executive branch. They don't have the authority to just, pass a requirement. They can pass the requirement, okay? They do have the authority to pass the requirement. But then you could have the legislative branch come in and say, okay, SEC, we're going to clip your wings and we're not going to allow you to do something. So the lobbying started, and companies did not want to go over to IFRS for the reasons, the cost of converting. There were certain aspects of IFRS that they didn't like, that they wanted to lobby against. And so Congress turned to the SEC and said, calm down, buddy. You're not going to just flip the switch and go over to IFRS. So, and now it has waned in significance in how folks look at reporting for U.S. companies, etc. Okay, so I was in front of the Cal State LA folks, and I told them, look, if you look at what Congress is saying at that time, Congress actually argued about this very fact. You give something for Congress to argue about, what do? They argue, right? So they went back and forth about how some folks in the debate thought that it was better that IFRS allowed you to capitalize the development. Other folks said, no, because investors will be harmed, and that was the empirical study at that time, etc. So U.S. GAAP still says what? Expense all research and development just in case it goes downward. Notice how important the rule of conservatism is, okay? So they tell us it's generally expense. Now, they come in and they say that there are certain exceptions to that rule, okay? And you can kind of almost feel the FASB arguing with itself here, right? As it says, hey, expense, unless, and they say only capitalized direct cost incurred in developing intangible. And the classic example, okay, is legal cost, and I want you to go ahead and underscore that legal cost, okay? God, Microsoft should really work on this, okay? The legal cost, okay, is what could be capitalized for an internally developed intangible asset. For example, let's say I'm developing a patent. And as I'm developing that patent and I'm getting ready to register that patent, etc., I have to pay some legal fees, okay? Well, that I can capitalize, okay? Or let's say you come to me and you say, I was working on that, you stole that patent from me, I actually have the right to develop this thing, I'm taking you to court. And so now I have to go to court and pay legal fees to successfully, okay, defend the right to that patent. I can capitalize that, okay? So when they say legal cost, it's what? It's successful legal cost. Okay, so it can be a little bit more specific there. If I lose the case, okay, well, that's like any other legal fee. Then I'm going to go ahead and do what? I'm going to expense the cost of those legal fees. And let's say I had bought the patent from a third party and I had recorded it appropriately as an asset because I bought it from a third party, and then I get somehow challenged in court and I lose the right to that patent. Not only do I expense the legal fees, I got to write off the patent at that point because I don't have any future economic benefit associated with that. Okay? Okay, good. And you can see what they talk about the debate, and I probably went on too long about that, so I'm not going to say any more about the notion of debate, okay, with the intangibles. You can see that it's an area where there's been a fair amount of attention, or you can maybe tell from my story, where there's been a fair amount of attention around that, and so I think you get the point, right? We're going to expense the cost of developing intangibles, okay, with the exception that what? We pay things like legal fees, registration costs. Yes, we can capitalize those. Or if we have to go to court to successfully defend our right to the patent, we capitalize that. But the actual nuts and bolts developing that expense. Okay. Now, when we look at our intangible, we will need to amortize that. Okay. Now, we have intangible with limited life. Okay. But we're also going to see, as we move into the next few slides, there are intangibles. By the way, guys, that I don't put that, Wiley does, and okay. Every time I look at those, I'm like, I have no idea, where I am in this discussion. It's 5 of 7, and then when I look, I can't figure out why this was 5 of 7. I can't figure out why the last 7 slides I looked at was 7 of 7. Okay, so please don't get distracted by that thing up there. Okay, anyway, just coming back now to our discussion. When we look at our intangibles, okay, we're going to have those with a limited life, and we're going to have those with an indefinite life on some of the upcoming slides. Okay. Now, when we look at indefinite life, okay, that means we don't know how long that life is going to last. Okay. For example, goodwill. Who knows how long goodwill is going to last, right? So amortizing that doesn't make any sense if it has this indefinite life. I mean, if you're Walt Disney and you're sitting there drawing a mouse and ears, you didn't think, okay, I hope anybody ever likes this, right? And then what happens? Then over years, now we got whole empires built around a mouse, essentially, right? And so a cartoon mouse. So what happens? You sit there and you say, okay, well, how long will that future economic benefit last? Who knows, right? Okay. And so for things like goodwill, we're not going to amortize those, okay? For limited life intangibles, right, where we know that it only has a certain amount of life as opposed to an indefinite life, then those we will amortize, and we call it amortize. But amortize is sort of like, it's the concept is very, very similar, if not almost virtually identical to depreciation, but we call it amortization. Okay, so an important difference, though, when we were talking about depreciation in our chapter 10 or 11, I guess 11, we did what? We debited depreciation expense. We credited accumulated depreciation. Accumulated depreciation then was presented as a contra to the original cost of that asset. The original cost of the asset minus the accumulated depreciation gave us the book value for that asset, right? Okay. With intangibles, rather than crediting an account accumulated amortization, we generally just credit directly to the intangible asset account and don't report an accumulated amortization. That's generally the case. Again, FASB does not get up in your face and you will record things this way a lot of the time. So they do also allow, if a company chose to report an accumulated amortization. But for the most part, companies just credit the amortization expense as a debit. Every journal entry has a debit and a credit, right? The credit is going to be to accumulated amortization. Okay. Now, the useful life will basically be the period over which the asset will contribute to cash flows. And you say, well, what does that mean? Well, look, we can't necessarily look at a patent and say, you know, I think that piece of paper, yeah, looks like it might actually last 20 years. That looks like high quality paper. Okay, you can't use the physical life approach that we use, and we see that was key to almost all the depreciation methods we looked at. Now it's more of a matter of, well, how long will that particular item continue to have future economic benefit to the company? In other words, continue to contribute to cash flows. Now, in some cases, it involves some sort of estimating technique that we'll have to do. In other cases, there are legal statutes that limit the life of some of our intangibles, and we'll see how we'll use that information in calculating the amortization. Okay, good. And I guess if there's some residual value on these, we'd subtract that. Okay, and we will evaluate. Basically, you evaluate all assets for impairment. Okay, they're saying that down here, but all assets are going to be evaluated for impairment, and we're going to have to calculate impairment gain or loss. Okay, what we're going to see is that for our limited life intangibles, there's no difference from what we talked about the evaluation. When I say all assets, you don't have to evaluate cash for impairment, obviously, but most assets will have a process where you evaluate them for impairment. When we're talking about sorry guys, let me say that several assets will be valued for impairment, because as I'm hearing myself talk, there's different methods that you use as to how you determine the carrying value of assets. Cash is just the cash. Accounts receivables net of the uncollectible amounts. Inventory is lower cost or market. Stop, John. For most assets, especially our fixed assets like we saw last time in chapter 10, we evaluated our fixed assets for impairment, right? When we talk about our limited life intangibles, we're going to use the same process for determining an impairment that we use for our fixed assets. When we get to our indefinite life assets, we're going to see that there's a little bit of a different approach that we have to use sometimes to evaluate impairment. But all of our longer term assets get evaluation for impairment. The method's just a little bit different if we're talking about a indefinite life intangible. And let me stop talking about that indefinite life without showing you on the slide here, right? So indefinite life, no foreseeable limit on time the asset is expected to provide cash flows. Who knows, okay? Let's say I'm a company and I've acquired the goodwill from another company. I record that on my books, right? I don't know how long that goodwill is going to last. Could last forever. Could be gone tomorrow if I have something that destroys that goodwill, right? Okay, so we must test for impairment at least annually. but we do not amortize. You don't amortize because you don't know how long that life's going to work. So you're going to evaluate it for impairment. So let's say I purchased a company and I purchased more. Let's say I bought a restaurant. Let's get this picture in our head. Okay, I buy a restaurant, and I buy this restaurant, and you take. Back up. Let's say we're almost out. Your first midterm is going to be Valentine's Day week, okay? So let's say, it's Valentine's Day and you take someone you really love to a restaurant, right? Or they take you. Someone you really love takes you to a restaurant. And they take you to this beat up restaurant, bunch of old equipment. The seats are kind of, beat up. And you're thinking, geez, here it is, Valentine's Day. I thought this person really loved me. And they bring me to this horrible looking place. What's wrong, right? And then they serve the food and you're like, oh, I'm in love again, right? What wonderful food, right? So you look around the place and you say, the assets, the building, the equipment, these lousy seats, probably worth maybe $50,000. So you call the owner over and you say, hey, look, I'll pay you $50,000 for all the assets in this place. The owner says security, and you get thrown out. They're not going to sell that place to you for $50,000, even though all the equipment and everything you perceive to have a fair value of $50,000. The guy's going to say, I want $1,050,000. Are you crazy? This is the best restaurant ever. Well, what's that extra million going for? That extra million is what? Is the goodwill, because the fair value of the building and everything is only $50,000. You paid $1,050,000. So now on the balance sheet now of the company that you've acquired, you will report what? You will report fixed assets, $50,000, goodwill of $1 million. Now, let's say you go ahead and you get going and you start developing new recipes. And you say, now we really have a good restaurant because of all these recipes we developed. So our goodwill is now gooder. And you can't even add to the value of an intangible asset that you bought from somebody else. The original cost, yes, some of them subject to then amortization, all of them subject to an impairment test, okay? But you can't make it gooder. You can't continue to add to that by doing all kinds of recipes, okay? So you would expense the cost of developing those recipes, okay? Now, let's say one day I'm following the recipes, that I already had available from the previous owner. They're now enjoying their $1 million in Hawaii somewhere or something. And I accidentally, dump some Clorox into my pancake batter, and a bunch of people get sick. And now all of a sudden, my restaurant isn't nearly as popular as it once was. Well, now my goodwill has been impaired, and I will have to write that goodwill down. I will literally debit impairment expense, goodwill impairment expense, debit that, credit the goodwill, and bring it down. Okay, so we test it for impairment. Okay, good. And again, that point about IFRS, just saying that they do allow you to capitalize the development, not the expenses, basically what they're talking about there. Okay, I mean, not the research. You can capitalize the development under IFRS. US GAAP, you expense, and that's all you're going to be tested on is US GAAP. We expense both the research and the development. Okay, all right, good. And you can see this slide might be helpful, and that it sort of summarizes some of the things that we said on the previous pages. Okay, all right, good. So let's go ahead then, and I'll tell you what I'm going to start doing, I think, is suggesting a break to you. Okay, you don't have to take the break right now. I'm going to pause. Okay, maybe I'm going to go ahead and take a little break here. You might want to pause the recording right now too and take a little break. It won't pause for you as far as the system's concerned. I'll be right back in 2 seconds. But if you want to take a little break, now's a good time, okay? And we'll continue on. Okay, so we're back. Hopefully if you took a break, you had a nice break there. And there's that summary slide that we were talking about before. And so now we're going to go ahead and start to take a look at the various types of intangible assets. And this really comes into play when we talk about the life that you will amortize it over, or whether you will amortize it at all, and how you will approach the impairment evaluation. Okay, so that's the areas that this will affect. So you come over and we talk about marketing related intangibles, and let me switch my pen back to highlighter. Okay, and so we have what? We have our marketing related intangible assets. Example, trademarks, trade names. Okay, Pepsi. I guess you had to mention Pepsi because we mentioned Coke before. We don't want to upset Pepsi, right? Kleenex, etc. Okay, so you take a look and we say that in the United States, trademarks or trade names have legal protection for indefinite period of 10-year renewal period. So you go 10 years, you renew, 10 years, renew. So they could go on, what, forever. And so we will capitalize the cost of acquiring those. That's the case with any of the intangibles. You capitalize the cost of acquiring, you expense the cost of developing, right? Point here, no amortization. No amortization because you can continue to, re-up that for an indefinite period of 10 years, but then you could renew it and that can go on forever. Okay, all right, good. Now we come over and we have customer related intangibles, such as customer list. So you go through all this effort to develop a customer list, and you've got good connections and how you use that customer list, etc. That's all expensed. Then a company comes along and says, hey, I'll acquire that company list from you. Or maybe they acquire your entire company in order to get a hold of that company list. Okay, if that's the case, now whatever the third party paid for that customer list, they can bring that on the books at whatever the cost was as an asset. So they would capitalize the cost to acquire it, and then simply amortize that over the useful life of that customer list, whatever you estimate that to be at that point in time. Okay, okay, good. So come over, just looking at some points here, how that would be amortized, and they give you this example, and they pay what, $6 million for it. So of course we're going to capitalize that asset, $6 million, and then they tell us, well, that's a lot of money for a customer list. I guess companies do this over a 3-year life. So each year we would amortize the expense, and then notice we credit directly to the intangible asset account. However, some companies could use an accumulated amortization, similarly to how we saw in Chapter 11 for depreciation. Okay, okay, good. Now let's take a look at artistic related intangible. Okay, example, music works. Okay, and they tell us the copyright is granted for 70 years for the life of the creator plus 70 years. Now that's the reason that anytime you want to play you can do that, and you don't have to pay any copyright costs, or you don't have to worry about any copyright infringement, because that's Beethoven, by the way, has been gone for a long time, right? So that's not copyrighted. But if you tried to use a Beyonce song in some commercial format, and I never quite understand how political campaigns get away with playing the songs of artists, because I noticed a lot of times you'd hear something blaring during one of these rallies that you were seeing during the political campaign, and I'd be like, well, gee, that could give the impression that that candidate is being backed by that artist. Meanwhile, I was understanding that some of the artists were saying, cease and desist, do not use my music anymore. And I don't know, these days sometimes rules just get blown up. So I'm not sure how they were getting away with that. But if in the general case, if you're going to use that music, you've got to get permission, and there's probably a fee that goes along with that. Prince, I saw a thing with Prince, or the artist formerly known as Prince, whatever he went by, where I forget what it was. It was some sort of credit card company, and they were playing a Prince song that if you listen to the Prince song, it was what he's talking about in that song is actually against the idea of charging things up on a credit card. So I'm thinking, okay, Prince is probably rolling over in his grave, but what? It lasts beyond the life of the individual for 70 years. Now, what I find interesting here is if you have a song written by the Beatles, they always wrote those under Lennon-McCartney. John Lennon has passed for some time now. Paul McCartney is still alive. So I don't know if it's two people that write together. Is it the first one to die or the second one that dies? And then it begs the question, well, what happens? Because the Lennon-McCartney, the Beatle catalog was purchased by Michael Jackson. So I don't know what happens there. Is it the life of the creator or the life of the person who purchases? So you could get into my point in all this. Let me stop. Is that you could probably get into a lot of nuance when it comes around this. Okay. But they don't want to sit there and say, oh, okay, well, we're going to have to do some sort of family tree calculation to see at some point they're going to cut that off into a reasonable period of time going out 70 years. After a while, people start to lose track of their lineage, right? I was talking to my nieces and nephews the other day about how I took a trip to Puerto Rico, and it was interesting to go and look at some of the parts of Puerto Rico where my mother's family came from, a couple generations back. My niece and nephew looked at me and said, we're Puerto Rican? Okay, so, there's a lot of things that get lost over years. So rather than creating an impossible thing to try to track, the point of this, and I don't know, all the ins and outs and the rules, obviously, as to how that works, but they do try to limit that somehow, okay? And so you capitalize costs and then amortize, right? Because there is a limit to how long they let these copyrights go out. You amortize that over that useful life, okay? Okay, good. Now you come over and we talk about now the costs related to intangible assets and contract-related intangible asset. Example, franchise. So what happens? Okay, so let's say I take one of my breaks and I decide, I'm going to go before COVID, right? Someone might sit there and say, I'm going to go relax and take a walk around the shopping mall, right? So you go and you take a walk around the shopping mall and you see a long line. And, you say, what's this long line about? And you go and you look, and it's this Auntie Anne pretzel place, let's say, okay? And you say, wow, here I'm studying hard accounting. I'm thinking about my license, my CPA. Should I go that route? I'm going to go to that event and hear from the California Board of Accountancy in a few days. I should check that out, right? So what happens? You go, I'm doing all this hard work, but maybe there's another way I can make money. What's this long line? So you look and you see that they're waiting in line for an Auntie Anne pretzel. What is it? Flour and water that they flip into a pretzel shape. Everybody, comes and pays $4 for flour and water. You think, wow, this might be a good way for me to make money. So you call up Auntie Anne and you say, hey, Auntie, how much for the right to hang up a franchise sign? And she says to you, well, dear, here's what we do. We're going to charge you $50,000. That'll give you the right to hang up that sign for 10 years. And we'll even provide you the service of telling you the best place to hang it up so that people will come and, pay $4 for flour and water. So you say, okay, that sounds great. So you pay her the $50,000. Does that $50,000 have future economic benefit? Yes, it does, because you can have people come pay $4 for the next 10 years for that. So you debit the intangible asset, you credit the cash for the $50,000, right? Okay, that has value, and you're going to amortize that over that 10-year life that it has that value for you, right? Okay. Now, let's say you start up right? You paid that $50,000, and now Auntie Anne, you start to try to twist the pretzels. I don't know if you ever watched them do this. It's hard, okay, because it looks hard to me. I don't know how they do. They throw a piece of dough and it folds into a pretzel. You're like, I can't do that. I got a square, I got a triangle, I even got a rectangle one time. I can't turn it into the pretzel shape. Can you show me? She says, no problem, dear. What I'll do is I'll come back and I'll train you how to fold the pretzel, and I'm going to charge you 2% of your revenue over the next couple years while I teach you how to do that. Over the next year, whatever, while I teach you how to do that. You say, okay, because nobody wants to eat a square piece of dough. They want a pretzel piece of dough. So now she comes and she's charging you against your revenue. That's expensed. The cost of, by the franchisor that is provided, the cost of the franchisor, you would be the franchisee, Auntie Anne would be the franchisor. The cost of the franchisor charges you for ongoing expenses like training and whatnot. That is expensed. But that upfront fee, that's capitalized, and then depending on the life of that, that's amortized. Now, if you're sitting there and you are, say, McDonald's, and McDonald's is saying, well, look, we have this restaurant and we have this right to hang this thing out forever, and it has an indefinite life, right? Now you're not buying the rights. You're the owner of that particular type of franchise. Or you buy it from Auntie Anne and she says, you can hang this sign up forever, not for 10 years. We'll let you hang it up, not for 20 years, not for 30 years, the rest of your life, and you can pass that on to your heirs or whatever it is. Well, if that's the case, then that franchise would have an indefinite life and would not be amortized unless somehow, it came out that, Auntie Anne Pretzels cause baldness. Then, all of a sudden, there's no value to this. No one's going to line up anymore to buy these. Okay, so if it's a limited life, yeah, like what I described, amortize it. Unlimited life, don't amortize it. But again, just keep in the back of your mind that all assets are evaluated. All fixed assets, intangibles, are evaluated for impairment. I guess I'd be remiss if I didn't point out the NFL, wearing an NFL team shirt. That's a valuable little logo. If you are, I think the logo right now is with Nike. Before it was with Reebok. So if you get the contract with the NFL to produce shirts, with the Nike swoosh on them, I don't know. Yeah, okay, here it is right here. I don't know if you can see that, right? Okay, but you got the Nike swoosh on NFL products. Whatever Nike paid for the licensing fee to be able to put an NFL logo on a shirt, they paid plenty for that. That has future economic benefit. They would capitalize that. And then they would, and I'm assuming I'm sure that one probably has limited life, obviously, because Reebok had it, and then Nike took it over. I think that runs for like 3 or 4 years, maybe 5 years or so. I don't know how long, but then they would go ahead and amortize it over that life. Okay, good. Let's go ahead then, and let's take a look at technology related. Okay, and this is where we start to give into patents. And it gives the patent holder the exclusive right to develop a particular product, whatever, for 20 years. So what happens? Let's say this thing, okay, was actually a thing that I could put a little deal in my ear. And by putting that in my ear, now this thing can read my thoughts. And I don't have to dial anything anymore. I just have to think, okay, type up this text message, and I just think. I don't even have to speak. I just think. Well, that's probably fairly valuable, right, as a patent. So what happens? I spent all this money developing that patent. I expense it all. Now you come along and you say, well, look, John, great idea. You seem like a great idea guy. You're horrible when it comes to actually administering this. Getting the product developed, getting distributed, all that sort of stuff, okay? And when I'm hearing myself say this, I'm thinking about kind of like the way the whole vaccine thing went, right? They developed the vaccine. I'm sure they probably have patents on that. It's one thing to develop it. It's another thing as to how you actually end up distributing that and whatnot. And we're seeing that that's a little bit more of a challenge than just developing. Yeah, there's developing, but then there's the chain supply management issues that get into actually, getting a product on the market, that sort of thing, right? So maybe I'm good at developing stuff like that, but I'm not great at the next phase of the business, which is getting it distributed. So you come along, you say, John, step aside. I'll pay you for the patent, and then you go ahead and go vacation, and I'll go ahead and distribute the product. Well, when you pay me for that patent, whatever you pay me for it, you would debit the patent asset, the intangible asset, and credit the cash. And then you would what? You would amortize that, and the patent is granted by the U.S. Trademark Office, and they would then amortize that over the 10, in this example, they tell us there's a 20-year legal limit on that. So you capitalize costs, amortize over legal life or useful life, whichever is shorter. If you have a patent to develop flip phones, okay, I remember when they first started, really coming out with the flip phones, and there was this one called the Razor. I had to have it. Oh man, this thing is cool. It's thin and it's black and it's cool, right? And now if I walked around with that phone, people would probably say, hey, dude, get with it. Or that thing's obsolete, right? You don't look cool anymore. So what happens? The patent to develop that particular phone, let's say, maybe would have had a life that was shorter than this 20 years, okay? And again, as we've stated a number of times, so you would then use the useful life, which would say maybe 4 years or something like that. I don't know, I'm just making that 4 years up. But then you would expense the cost of developing that, okay? Okay, good. Let's take a look at how it might look when we purchase the patent. And they tell us that the patent has a useful life of 12 years. Okay. And, let's read this whole question. Okay. So, what is it? Haircut company incurs $180,000 in legal fees on January 1st to successfully, very important phrase there, successfully defend a patent. And we're going to amortize that over the useful life of 12 years. So they take that 180,000, they capitalize that, and then they divide the 180,000 by 12, and they would then amortize that. Okay, and you could either credit to patent directly, which is generally the case, or accumulated depreciation. Now again, if I acquired that patent from a third party, I would capitalize the cost of acquiring that, and then I had to go to court and I successfully defend my right, I would add that to the overall book value at that point of that patent and then divide it over that remaining useful life. If I had developed the patent myself and I got challenged for some reason, I would have expensed the cost of developing, but these legal fees, okay, I could capitalize the cost for a successful defense. If I'm unsuccessful, what am I doing? Well, I guess I don't have the patent anymore, and I'm expensing the legal fees. And if I had acquired that from a third party, and somehow I lost the rights to that through some sort of legal case of some sort, then I would have to do two things. One, write off the patent and expense the legal fees with that. Okay, so that's the way legal fees work in those cases. Okay, so I think this problem, since they're just showing them the capitalization and amortization on the legal fees, this example must have presumed that they were the ones that had developed the patent. Okay, all right, good. Let's go ahead and move on to the next section. And I'm not going to take an official break right now, but if you feel you're getting a little tired, are you tired? Okay, if you're getting a little tired, you may want to go ahead and take a little break. Okay, so let's go ahead and take a look at our next area, and now we're going to be talking about intangible with the indefinite life, we're going to be talking about goodwill. Okay, now goodwill is a little bit special as our intangible assets because it's probably the least specifically identifiable intangible. Essentially, again, back to our example of the restaurant, you look around, this place must be worth $50,000. Meanwhile, it's worth $1,050,000 because of the value of the recipes and whatnot that draws all this business. Okay, now it tells us that it is acquired in a business combination, not individually identifiable and separately that are not individually identifiable and specifically recognized. So generally, when you get goodwill, it's because you have acquired, and I don't want to go with entire business because you could record goodwill, and what happens, and this is getting a little bit more into a little bit towards advanced accounting, although we'll talk about some of this a little bit later when we talk about accounting for investments. But basically, if you buy less than 20% of the stock of a company, you account for that using the cost method, and there's no consolidation. If you acquire 20% or more of the stock of the company, then you account for that 20% or more of the company up to 50%, 20% up to 50%. Then you use something called the equity method to account for that, but you still don't consolidate. You don't begin consolidating until you own 51% or plus more than 50% up to 100% of the stock of the company. Then you begin consolidating, and it's only on the consolidated statements that you will report goodwill. Okay, now we're not going to get into consolidation in this class. I just want you to keep in the back of your mind that when we talk about the recording of goodwill, keep in the back of your mind, and I'll repeat that. When you're talking about the recording of goodwill on the financial statements, that only happens in the consolidation process when you actually consolidate the acquiring company with the acquired company. Okay, in an acquisition. Now again, you don't capitalize the cost of developing goodwill. All the training, all the hard work you put into developing those fantastic recipes, expensed. It's only when you acquire it, and you generally acquire it when you're acquiring the company, you're buying up the stock, whatever, of that company. And even then, you can calculate what the goodwill is, but you don't actually report the goodwill on your financial statements until you're getting to where you're consolidating a company that you own and control. And we've determined that to mean that you own more than 50% of the voting stock, with some other stipulations that we won't get into here. But when you start to produce that consolidation, that's when you report the goodwill. Okay, now goodwill, okay, let's just see what it is the excess of cost of the purchase over the fair value of the identifiable assets, net assets. Net assets is assets minus liabilities, purchase. Okay, so again, I look around, okay, net assets, I don't know what liabilities I'm acquiring as part of this, but my net assets are $50,000. Hey, here's $50,000. Guy says, well, get out of here. I'm not selling you this place for $50,000. This place is a gold mine. Are you kidding? He says, I want $1 million. So we sit down and we figure out, I want $1,050,000. We sit down and we figure out, okay, yeah, I guess it is worth $1,050,000, right? So I pay him the $1,050,000 to acquire that company. That $1 million is going to be what? Is going to be goodwill. And again, I would only report that goodwill if I'm consolidating that in with and I'm assuming I already have a company and I'm pulling them into my company. Now that segment or whatever into my company, then I would report that goodwill. Of course, if I was, sitting around my house before that and I just decided to, buy this business and I paid $1 million, then I would only be having the financial statement of that business and I would report that goodwill. But when we look at the examples, what's going to be contemplated here for the most part is going to be, hey, you already have a company, you acquire another company, and they're going to be showing the reporting of the goodwill. But that's really something that happens when I go ahead and now consolidate the two companies, and the consolidation would include things like if there were intercompany receivables and intercompany payables, those would be eliminated as part of that consolidation, as well as writing all assets up to fair market value and recording the goodwill. Okay, beyond the scope of where we're going here, guys, this is the most important thing here. Okay, that you realize that when you pay more than the fair market value of the net assets, that difference is going to be goodwill. Okay, and again, internally created goodwill, okay, is I'll go ahead and change the color on that, I guess, is not capitalized. All the money spent for training, that Nordstrom spends for training, etc., expense. Okay, good. So let's go ahead and let's take a look at a couple of examples. Illustration here. Multi-divisioned Inc. decides that it needs a parts division to supplement its existing tractor distribution ship. Okay, so this is what I'm talking about. The examples, they're talking about an already established company acquiring another company. Okay, I'm just pulling it in as a division. Again, the process that they're going to look here, and they're literally going to show you a journal entry. That's part of the consolidating journal entries. You would consolidate the two. You could still pay more than the fair market value for the portion of the assets you acquire. So now you acquire what? You acquire 40% of the assets. And if you pay more than the fair market value of the 40% of the net assets, so let's say the net assets are $1 million. You acquire 40% of the company. Okay, so what you're acquiring is what? Something worth $400,000, but you paid $500,000 for that. Well, that $100,000 is goodwill. But since you're not consolidating those financial statements, you're going to account for it using the equity method. That goodwill isn't reported anywhere. Now, if you bought 70% of the stock in that case, now what are you going to do? Well, now the U.S. GAAP requires that you consolidate that company. So you're sitting there, and it was $400,000 was the fair market value of the assets. You paid what? You paid 70%. You bought 70% of that, so that's $280,000. But you paid $300,000. Now, when you consolidate, you'll do what? You'll sit there and you'll take, in that example, $20,000 of goodwill because you're now consolidating that company in. Okay? All right, so that's what they're doing here. They're buying the tractor company, and the illustration presents the balance sheet of the tractoring company. We have what? We have our total assets here. We have liabilities of $55,000. So first trick here in figuring out what the goodwill might be here is to figure out what the fair value is. So that's the book values. The fair value is what? Of the net assets. What are we looking at here? Are we looking at book value or fair value? It looks like book value, okay, of the net assets. Then we go ahead and we sit here and we list out the assets, and we have fair value of net assets, assets minus liabilities. Sorry guys, I'm not sure if what they're showing me here on this balance sheet, accounts cash 25, accounts receivable 35, inventory 42, property plant equipment 153, 25, 32. Okay, inventory 122. So they could have probably made that a little bit. Well, I guess they did. This is the book value. Notice, okay, as we've discovered together here, there is a difference between the book value and the fair value. So the fair value of the net assets, assets minus liabilities, is $350. Okay, so what happens? We sit here and we assign the different pieces of the purchase price to the various assets, and then we have what? Fair value of the identifiable assets. Purchase price was what? Was more than the fair value. Okay, and so once we've assigned all fair value valuations that we can to the identifiable assets and liabilities, then what? We paid more than that, so that difference is going to be the goodwill. Okay, so you look at the fair value. Always focus on fair value. Look at the fair value of all of the identifiable assets, assign the fair values accordingly, assets and liabilities, difference between assets and liabilities would then be the fair value of the net assets. Assets minus liabilities is net assets. Fair value of the net assets, compare that to the purchase price, that difference is goodwill. Okay, I'm going to say that one more time. I'm going to say it a little slower. Okay, so what do? We assign fair value. Okay, I know I showed you the book value there for a second, but we assign what? We assign the fair value to all those assets. I don't care what the company was putting them on the balance sheet. I'm going to assign fair value to all of those. Okay, fair value to the liabilities. Assets minus little liabilities is net assets. Gives me the fair. Remember the word fair. We want to be fair when we acquire a company, don't we? Okay, fair value of all of those. Okay, fair value of the net assets versus the actual price I paid to acquire those. Difference is goodwill. That's it. That's it. Okay, in spite of all those other things I said, that's all we're doing here. Okay, just keep in the back of your mind, okay, that this journal entry that you see here, this would only happen if we had done what? If we had gone to a more than 50% ownership stake, then we would have to do this consolidation. And in this case, they're assuming that they went ahead and acquired all of the assets. So they're going to go ahead and, you know, the way they would do this in a consolidation, to be honest with you, is you'd have a consolidating worksheet. You'd have the financial statements of the parent company, the financial statements of the acquired company, and you basically would add columns across. But in some things that aren't on the books of the individual companies would need to be brought on the books of the consolidated company, including you would have to sit there and write up the assets to fair value. You'd make entries to eliminate intercompany transactions. You'd make journal entry to eliminate the investment account on the parent's books, etc. There's a bunch of things that you do, and so we're not going to do consolidations in here, guys. Don't worry. The key thing is that part of the consolidation would include bringing in an asset called goodwill, okay? And that asset goodwill is going to be carried as a specific line item on the consolidated financial statements. Goodwill, line item on the financial statements, okay? All right, so you pay more than the fair market value of the net assets. That difference is goodwill. That difference gets reported on the balance sheet of the acquiring company, or if you didn't have a company before and you just acquired it, yeah, you would report that goodwill on the balance sheet of the company now that you have purchased, because you purchased that goodwill. And that goodwill is a difference between the fair market value of the net assets and your purchase price. Okay? All right, good. Now they go through that another couple of times here, guys, and you know, they give you the fair market value of the net assets, and let's see, looks like they paid $300,000 for that. And what they did is they look at the goodwill as the difference between not the book value of the assets, but what? The fair value of the assets. That difference is goodwill. So you would go ahead and say, okay, look, I've got to write all the assets up to their fair value, and then if I still, all the assets and liabilities up to their fair value, and then if I still paid more than the fair value of the net assets, that difference is goodwill. Okay? All right, and you can see here, you know, again, they calculated that goodwill in a similar manner, and then you can see all the journal entries they make here to bring all the assets up and liabilities up to their fair value. They credit cash. Difference is goodwill. That's going to report it on the consolidated financial statements of the two companies, or if I didn't have another company first, I just acquired it as a private individual, I acquired that company, then I will go ahead and report down the goodwill on those standalone financial statements of that company that I just purchased. Okay? Okay, good. Now, what happens? Goodwill is considered to have indefinite life. Should not be amortized. Okay, but we do have to go ahead and evaluate it for impairment, and we're going to talk about how to evaluate all of our intangible assets for impairment. We're going to see goodwill kind of has some interesting methods there to evaluate the impairment. We'll talk about that in our next section. Okay. Bargain purchase. Hey, nice work if you can get it. Okay, bargain purchase is saying, look, you're going to acquire the fair market value of the assets of this company for less than their fair market value. Now, who's going to do that? Okay, you've got all these assets. They have a certain fair market value associated with them, yet I'm going to be able to acquire them for less than their fair market value. Well, let's take an example here. Maybe a little bit in the fantasy world, but I think it illustrates the point. Okay, so let's say you have two hotels side by side, and one hotel, they're identical in every way in terms of the physical assets of them, but one hotel says, I don't know, Marriott on it. The other hotel says Trump on it. And so you're looking at that and you're like, okay, I don't want that hotel that says Trump on it, because there's a certain amount of, right now, let's say, bad will with a hotel that says Trump on it. Okay, if you like Trump, sorry, just humor me for a minute, okay? So what's happening? We're sitting there and we're saying, well, no, that hotel that says Trump on it is not very valuable right now. So you go and you talk to the Trump companies and you say, look, I know you don't want to be in the hotel business anymore. And so even though the fair market value of all the assets of the net assets of the hotel is worth, $100 million, I'll pay you $90 million to get it off your hands. Okay. And they say, okay, because we just want out of this. Okay. All right. So if that's the case, that's a bargain purchase. That means you purchase the net assets at less than their fair value. And again, it's, again, my story is fanciful. Okay. I realize that. Okay. So what happens? That's not going to happen very much. But if it does, that's considered a gain. Okay. That's considered a gain. So now you would go ahead and in that case, go ahead and recognize a gain for that, okay? For that difference between the fair value, say the fair value was $400,000 and you were able to pay $350 for that, then you would have what? You would have a $50,000 gain that you would report on the income statement, okay? Okay, good. So let's go ahead then and let's sort of move past that discussion and let's talk about our next part here, which is going to be talking about now our impairment procedures for our intangibles. Now, as you go through this stuff, what you're going to start to feel is, wait a minute, where have I heard this before? And where you heard some of this before is in the discussion in chapter, sometimes I forget which chapters, guys. I think it was chapter 10 or 11. I forget now already. I forget, where we talked about impairment for our fixed assets. Okay, so it's some for our what? For our intangible assets with finite life. It's going to be the same thing that we heard for our fixed assets. It's not until we start getting into our indefinite life intangible assets that we're going to start to see a little bit of a different approach. Okay, so let's just go ahead and let's take a look. Limited life intangible, same as what we said for our, and I'm going to change the color off of green here before I forget. I keep wanting to do that and I keep getting into the discussion and I forget to change the color. Okay, so all we're going to do here is the same thing that we did for our fixed assets, which is what? I'm not going to even look at the slides, guys. Don't look at the slide. Well, you can look at the slide, but you don't have to, because you can just listen to me and review what we learned in the other chapter when we were dealing with fixed assets, which is what? You sit there and you look at the cash flows that are going to be generated from the use of that asset. You don't discount those cash flows, right? Those cash flows are undiscounted. And if those cash flows are more than the carrying value of the asset, then what? You don't have impairment, you stop, and you don't have to do any impairment value any loss calculation, loss on impairment calculation at that point. There's no loss, there's no impairment, you stop, okay? Now, if you look at the cash flows that are going to be generated from the use of this now intangible asset. Same thing we said for fixed assets, right? Intangible asset with a finite life. Okay, if it's the same, if the it's the same as we said for our fixed assets. If the cash flows are what? Less than the carrying value of the asset. Carrying value is book value, original cost minus the amortization in this case. If those cash flows are less, you're not going to recover your cost. You now know that you have impairment. Now you go to step 2. Okay? And if you know that you have impairment, you've gone to step 2, then you're going to look at the difference. And the difference is the calculation of the impairment loss is very simple. It is simply the fair value versus the book value of that asset. Now, how do we determine fair value? I think you saw in whatever chapter it was that a lot of time the problem just gave me the fair value. And that's probably going to be the case is how I'll test you. But I think it's worth noting that often what we'll do to calculate the fair value is take the same cash flows that we took to determine if we have impairment, which were undiscounted, take those same cash flows, discount them, use that as the fair value, compare that to the book value to calculate what the impairment loss is there. Okay, so it's exactly, I'm sitting here struggling with chapter, and the book's telling me it's exactly the same thing we said in chapter 11 for fixed assets. Okay, good. Now let's go ahead and you can see this example, and we have expected future cash flows. We have what? We have the carrying value. So in this example, because the expected future net cash flows, which would be undiscounted, versus the carrying value, the expected cash flows are less than the carrying value. We have impairment. We will go ahead and calculate now the impairment, step 2, by comparing the what now, and again, it could be, you notice they say present value, so it could be the discounted cash flows, those same cash flows that gave us 35 million before. When you discount them, they're only 20 million, right? Present value is always less than the undiscounted amount, right? We discount that difference becomes the loss on impairment, debit the loss, and when we deal with fixed assets, we credit it to the accumulated depreciation account. Here we're going to credit directly to the intangible asset account. Okay, good. Not too bad. That's actually a nice review of what we talked about in chapter 11 for fixed assets, right? Okay, now you come over, companies may not recognize restoration of previously recognized impairment loss, okay? And that's the case for our intangible assets. For our fixed assets, remember we had 2 different scenarios. If the asset is held for use, we do not restore. If the asset is held for disposal, then you could go ahead and restore, but not in excess of the previously recognized losses. In other words, you can only write it back up to its initial book value, carrying value, and you couldn't write it up beyond that. Okay, so with intangibles, they're telling us you're not allowed to write those back up. Okay, good. Now let's go ahead and let's take a look at what happens if it's an indefinite life other than goodwill. As I've said, goodwill is kind of interesting in that it has its own rule. For our other intangibles that are in indefinite life, okay, what do? It's pretty easy, guys. It's basically look at the difference between the carrying amount and the fair value. That's it. None of this step 1, then only go to step 2. You do step 1. You look at the fair value versus the carrying value of that asset, and what? And an impairment loss is recognized if the fair value of the asset is less than the carrying value. So very simple. Just simply look, and you don't have to go through that step 1, that recoverability test. It's really just and you can even write that, okay? It's really just a 1-step process. Okay, it's just that what was that second step for intangibles with a finite life. If it's indefinite, you don't worry about step 1. You just go straight to step 2. It's a 1 step, which is the step 2, which is just compare the fair value to the carrying value. And if the fair value is sitting there and is less than the carrying value, you record the impairment. Okay, so here was the carrying amount of a broadcast license here. Here was the fair value. Notice in the problem they don't talk about determining if you have impairment by comparing the undiscounted cash flows to the carrying value first. No, you just come straight over and you just compare fair value to carrying amount. The only thing that was weird in this question to me, I'd like to see where you can get an FCC broadcast license for $2 million. Okay, I mean, a broadcast license is almost a license to print money. Okay, you get on the radio, you sell advertising, and you can probably make some money there. And so for them to sell it for $2 million, that sounds a little unrealistic. Maybe I don't know enough about the broadcasting business to be qualified to say that. I do have an AA in broadcasting, and my sense was that the value of a broadcast license, I'm thinking, is a lot more than 1.5 million or paid for $2 million for something like that. I don't know. Maybe broadcast media has gone down the tubes that much. So anyway, stop. That's enough of that. Okay. All right. Now that's for what? That's for an intangible with an indefinite life other than goodwill. So what do we do when we calculate the goodwill? And you say, well, John, we're back to a 2-step process. So what's going on here? Okay, we said for intangibles with a finite life, okay, we use a 2-step process. You say indefinite asset with a indefinite life intangible asset, you said use the 1 step, just compare the fair value to the book value. Now we're back to 2-step. Why do we have to come back to 2-step here? Well, they're not the same steps. It's 2 steps, but it's not the same 2 steps that we saw for the intangible with a finite life. Okay, so let's just take a look. We say here, if the fair value is less than the carrying amount of the reporting unit, including goodwill, then we're going to perform the 2nd step to determine what the impairment is of the goodwill. Okay, so what happens? We're going to look at each reporting unit. The most important thing here is the reporting unit. In other words, we're going to do this by subsidiary of the company. Okay, this is why I was making the point earlier. This is part of why I was making the point earlier that when you start reporting goodwill, it's because you've consolidated in another company. And so now you're going to start to silo off the company by reporting unit to see to what extent there is some level of impairment in that reporting unit. And then you'll calculate the impact on goodwill by looking at the net assets of each reporting unit. So you could have a reporting unit where the fair value of the assets is more than their carrying amount. If that's the case, then you don't have any impairment, and you stop right there for that reporting unit. Then you come over and you look at the next reporting unit, and for the next reporting unit, now the carrying amount of those assets is less. Now the fair value is less than the carrying value of those assets. Now you have impairment, and you're going to go to step 2, and you're going to have to start to do the impairment calculation, which is going to be to assign the fair value to all the identifiable assets, and then take that difference between the fair value of all the identifiable assets and the total fair value, carrying value, of all the assets, and that difference will be the impairment of the goodwill. And I'm going to show you a numeric example right now. Okay, so let's just go ahead and let's take a look. And we have all these different assets. Let's read this question. Okay, I think it's complicated enough that it's worth reading all of it. So we have this Colby Corporation purchased 1 division print products 4 years ago for $2 million. Colby Manufacturing is now reviewing the division. Again, you would do this by reporting unit for purposes of recognizing an impairment. The illustration lists the print division's net assets, including the associated goodwill of $900,000. And so the net assets have what? Net assets have a carrying amount of 2.4, and we have a fair value for print of 1,900,000. Again, we would do this by reporting unit. Okay, if another reporting unit had a fair value that was, say, more than the carrying value, we're done with that reporting unit. We're not going to have to calculate any goodwill impairment, and then we'd go to the next reporting unit. We would do it a reporting unit at a time. Okay, now we come over and we have this difference. So we're saying, we've got impairment because the fair value of the assets are less than their book value. So what am I going to do? Step one, that's what they're telling me right there. They just repeated what I just said. And now is step one. And then step two is going to be to simply calculate that impairment and the difference between the fair value of the assets and what? And the net identifiable assets, including the goodwill of 2.4, means there's a loss on impairment. And when we take that loss, we take it all against the goodwill. Okay. Okay, good. Now this problem assumes that none of that fair value was used up in writing up other assets to a higher fair value. We signed the fair value accordingly in one big chunk, and then we just said, okay, the difference between the total fair value of the net assets and the book value of the net assets in this example was $500,000, and that all went against the goodwill. Okay, okay, good. All right, and you can see the summary page there as to how we will look at impairment depending on whether it's a limited life, a indefinite life, not goodwill, and then goodwill, you can see, had some sort of special rules, but really the main takeaway there is evaluated by reporting unit. So again, if you saw a problem where we had two reporting units and one reporting unit had a fair value of the assets that was more than, say, the book value, there's no impairment there, and you don't calculate any impairment loss on that. Then you go to the next reporting unit, and for that reporting unit, like the one we saw, let's say, that has what? That has fair value of the assets that's less than their book value, then you're going to have to, assign that loss to the goodwill, write down the goodwill, take the impairment loss. Okay? Okay, good. I think we're making good progress here, guys. Let's go ahead. If you need a little break, you can pause the recording and take that break now. I am going to go ahead and finish up. Okay? All right, so if you took the break, welcome back. We're now going to go ahead and we're going to wrap up our discussion and just quickly talk about how intangible assets are going to be presented on the financial statements. Basically, when I say financial statements, for these purposes, I'm talking about balance sheet and the income statement. Okay, so let's just go ahead and let's take a look. And similar to reporting proper plant and equipment, except that we generally don't use the contra. Contra means opposite. We generally don't use the opposite, the accumulated amortization account, although you could if you want to. Most companies do not. Okay. Now, when we deal with the companies should report as a separate item all intangible assets. So I'm going to take all of my copyrights, patents, franchise, intangibles, include them, add them all together, include them as one big category of intangible, but goodwill has a separate line item. So the goodwill comes in separate, and you can see that that's important thing to remember because, again, remember, goodwill really comes on the books when we do the consolidation of two different companies, right? Okay. Okay, good. So you can take a look then at the next slide, and that's going to talk about the income statement. And the income statement is where we're going to report the amortization. And so amortization expense, other than impairment losses and other than goodwill, is in continuing operations. Goodwill impairment losses should be presented as a separate line item in the continuing operations section unless goodwill impairment is associated with a discontinued operation. Remember, if we have discontinued operation, we do what? We have a separate section on our income statement for discontinued operations, and we report all of that information, including any impairment losses, in that discontinued operations section. And that's different from what? Obviously continuing operations. Okay, so you come over and you take a look at the next slide, and I think they do a nice job here just showing us how on the balance sheet, there's my intangible assets, and in there I might have a note that would describe to you and call out the different types of intangible assets that are constituting that line item, and then I'll have the goodwill. And again, I would be talking about the goodwill had been acquired as part of an acquisition, and probably be talking about the companies that constitute the consolidation and that, okay? And then on the income statement, I would have what? My amortization expense. And then because goodwill is not amortized, but there could be impairment loss, I would report impairment losses. And that could include impairment losses for goodwill, but I'd give a separate line item for my impairment loss. Okay, all right, good. Let's go ahead and talk about research and development. Again, research and development, generally, first thought in your mind should be, hey, research and development costs, what am I going to do? Expense. I'm going to report them on the income statement as research and development expense, right? Okay. Now, there are some exceptions to that, okay? And just keep in mind that that research and development expense line item is an important line item on the income statement, because analysts want to see how much you're spending on research and development versus, say, administrative, because they could look at those expenses, even though they may be creating a lower net income, a loss, are different, because even though FASB says treat them as expense, because most research and development goes down the drain, for some companies, Elon Musk spends money on research and development. We look at that a little bit different than if John is creating, research and development expenses, right? Because he's got a certain track record with his research. Okay? All right, good. So we come up and frequently result in something that a company patents or copyrights. But again, developing that, we do what? We expense research and development. It's going to hit the income statement, okay? And they give you some examples here of companies and how they have their research and development expense as a percent of sales, whatever. Some companies that are tech companies, like you can see there, they mentioned Facebook up here, are going to have what? Have R&D, a much bigger chunk of their expenses, and they use sales as a base here. You could use overall expenses, whatever. Some companies are going to have a higher level, and analysts will look at that a little bit differently. Okay, they give me some examples of what constitutes research, what constitutes development. I'm not going to sit there and get you into some sort of propeller head technical decision as to what constitutes research versus development. Okay, for US GAAP, you expense them both as part of the research and development line item. For IFRS, however, note that you can capitalize the development. You still expense the research. Okay. Now they give me some examples of R&D, and important thing here is that you put a little bracket there. If I can go through the annoying process of changing my pen. Okay, these are expensed, like most R&D. Okay, now computer software costs. Okay, they list it there, but computer software costs have special rules. Okay, and you maybe will see these if you read through the text for this chapter. I'm not sure if they put it in there or not, but let's just recall what is somewhere in my head about software development costs. Okay, so what happens? With the software development, what they do is like other R&D, okay, they tell you to expense, okay, up to something called technological feasibility. If I could spell, I'd be teaching English. Okay, so they have you expense up to technological feasibility. Okay, then you can capitalize after, and I'm going to call it TF this time, technological feasibility. Okay, so you expense up to technological feasibility, and then they tell us that we should go ahead and we should capitalize after technological feasibility. Okay, and this is something that kind of drives people crazy with US GAAP, because they're sitting there and they're like, okay, you know, first you told me to expense, and now you're giving me special rules in a FASB statement of position as to what I should be doing with software development costs, you know, whereas IFRS just tells you, hey, the rule is expense the research, capitalize the development, right? And so that's why people say that IFRS tends to be more principles-based, US GAAP more rules-based, because there are a lot of rules that come in that are sort of the exception to the general principle, right? Which is expense, research and development, unless we're talking about software. Here comes a rule in a statement of position from the FASB. You know, this is how you treat software, okay? Now, what happens here is you say, well, okay, John, I capitalize cost after technological feasibility. How do I amortize that? And here comes some more rules, okay? So the rule is that you should take the greater of the straight line amortization or amortizing the percent of the total estimated revenue. So what happens? Let's say I think this software has a 5-year life. Okay, so the straight line would be what? 20% per year, right? 1 divided by 5, 5-year life, 20%, right? Would be straight line. I would sit there and I would say, okay, let's say the revenue that I think I'm going to get off this thing is $1 million. That's the total estimated revenue from the whole project. That's an estimate, right? Total estimated revenue. And let's say in year 1, my revenue is 100,000. Well, if that's the case, then what? That means that in that scenario, okay, since that's a 10% calculation, that the straight line gave me the bigger amortization. So I would take 20% of the amount that was capitalized. I don't know, say I capitalized 10 million of software development costs that I had capitalized after technological feasibility, okay? Cost before technological feasibility already expensed. There's no need to amortize those off the balance sheet. Cost after technological feasibility, say it was 10 million. Well, you know, that would be kind of a crazy thing to do, to capitalize costs of 10 million for a revenue of $1 million. So let's say the capitalized cost was more like, you know, I don't know, 40,000, just to not have a ridiculous example here, because no company in the world would capitalize costs to develop a software that they're only going to generate $1 million off of, right? Okay, so let's say the capitalized cost was 40,000. In year 1, I would do what? I would take 20% using the straight line. Okay, now what happens? Let's say in year 2, the revenue that I generate off of this thing, instead of being 100,000, is and I'm just going to make up a number here. Let's say it's 300,000 off that $1 million. Well, now in year 2, I'd look at the difference between the straight line and the percent of revenue, and the percent of revenue in year 2 is what? 30%. So in year 2, I would take the 30%. So I go year to year and taking my amortization, okay, and I go year to year and taking the amortization based on which of the two gives me the greater, the straight line or the percent of revenue approach. Now, for some reason, I always get the question, so, well, would you depreciate the asset below its capitalized amount? And the answer is, of course not. Okay, once you've amortized that asset all the way off, either before the 5 years, maybe before the 5 years, if the percentage of revenue was greater, you stop amortizing. I mean, that is called change in accounting estimate, right? And since you have no more to amortize, you stop amortizing that at that point. Okay? Okay, good. Now you come over and where we start to talk about here how to calculate the amortization, or the not amortization, but the R&D expense, because most research and development is expense. You only get into that amortization, that special case with the software. Okay, and notice that what if they tell you that they spent money for R&D, it gets expensed. Boom, boom, boom. Right? Boom. These things get expensed. Okay, now when you look, the only time there was a difference between the amount spent and the amount spent and the expense column was here and here. Okay, so let's go ahead and let's deal with this 34,000 first. And they say materials purchased for future R&D projects. Well, look, you're not spending it yet for the R&D. It's future R&D projects. So you would go ahead and be able to capitalize that. But then when you finally use those materials, the future economic benefit expires and it is used for R&D, then it becomes R&D expense. Okay, and sometimes students will say, well, why is this so important, R&D expense? Because remember, we have a line item on the financial statements that's called out as R&D expense. So if you look at a question, let's say in the midterm, and it says it's R&D, and they use that item up during the period, R&D expense. If they haven't used it yet, then the future economic benefit hasn't expired, so it's not an expense. It would be carried like supplies on the balance sheet, but then when you finally use it for the R&D, it's expensed. Okay, now the other one up here was the fact that they acquired this equipment, and they're telling us that the equipment will be used for R&D for the next 5 years, and then it has a future life after the R&D. Okay, so what you do there is you would go ahead and figure out, well, what portion of that asset is being used up over this 5-year period. And so you would take that 280,000 and divide that by the next 5 years, so you don't use it just, you don't expense it all into R&D because it's an R&D and you say you expense all R&D. But if it's going to benefit projects over the next 5 years, then you would go ahead and depreciate that asset over that 5-year period, because it's going to have an alternative use beyond the current year. Okay. Okay, good. I think that's one more slide there. Just shows how R&D is a separate line item on the income statement. Again, it's an important line item that folks look at. Going back to that equipment, let's say they told you that the equipment had a 10-year life. For 5 years, it was going to be used for research and development, because this example only contemplated it being used for research and development. Let's say it said, well, we're going to use it for 5 years. We bought a building. We're going to use it for our research and development for 5 years, and then it'll have a life that goes on for another 5 years as an office building. Well, now you're going to sit there and you're going to depreciate it over 10 years, the useful life. And for those 5 years that you used it as research and development facility, right, you would take, say, the 280,000 divided by 10. You'd take what? 28,000 for the first 5 years. That's part of the research and development expense line item. And then for the back 5 years where you're using it for, say, an office building, well, you continue to depreciate $2,800 a year, but now that item isn't rolled into the research and development line item on the income statement. It might be part of my, say, my administrative, selling and administrative expenses line item. Same amount, but now it's rolled into a different line item. Okay. Okay, guys, I think that is some good work today. So hopefully that is helpful. Be staying tuned in the next day or so. You'll see the practice midterm for chapter 12 and the discussion associated with that. Okay, and then don't forget that depending on when you're watching this, assuming you're watching it before Monday, January 25th, 2020 at 6 p.m. Okay, if you're watching it after that, we'll probably have a recording posted up, but if I'd really like you to attend that to get the 5 points extra credit. And so I would like you to join us for that, and I'll be providing you the Zoom link for that. Well, you need to register for the event, so go ahead and register for the event. You can see that I'll post up. I think I already posted up the information to register for that here in e-learning. Let's just look at that. Let's take a second. It's worth it, our time here. Okay, so let's just take a look-see, although I have a feeling they're going to lock me out, but let's just look. Okay, in fact, it's worth us spending some time here. You see here, extra credit assignment, and I think I also put up an announcement. Okay, so I think if you go here, yeah, and I also emailed this to you. Okay, so you see the extra credit opportunity there, and you can see the registration link. Okay, so you have to register for that. I don't know if you can. If you can't, if it's not going to let you click on that, I'm not sure why it's doing that. If it's not letting you click, and you should have gotten an email, but you could also copy and paste that into your browser. Okay, and then you can register for that. There's also a PowerPoint that shows you, and that's the same one you see when you actually log in. Okay, but you can see there Nancy Corrigan, president of the California State Board of Accounts, is going to come. Again, you see the registration link, and they'll email you. Golden Gate will email you the Zoom link. That's Monday. Okay. Now, just to go back, get out of this, go back to e-learning. Okay, because I want to show you how you will submit that. Okay, so I knew it. Eventually I was going to click the wrong button. Okay, and you can see here extra credit assignment. Okay, so when you're ready, you take a selfie of yourself as a participant in that event up in Zoom when you're in there, and then you can submit that. Now they're telling me grade it. You know, because I'm the teacher, you'll have an opportunity to submit that, okay? And it'll just let you upload the file. You upload the file, I can see your picture, and it allows me to quickly go through and grade those because I can view the submission. I see your picture, boom, you get 5 points extra credit. I don't see your picture, you get 0. It doesn't affect your grade in that I'm not going to subtract points from your overall grade for that, but you won't be getting extra credit. And here's where students sometimes don't like me. They'll say, well, okay, John, I got a B+, I'd really like an A-. I'm, 4 points away from an A-. Can you give me the 4 points, or can you let me do something else to get those 4 points? And when I've offered an extra credit opportunity, I'm generally not sympathetic to that because I'm like, well, why didn't you go to the extra credit thing? So it would be really smart to go to this thing, and you're going to learn a lot about the opportunities for CPAs, the CPA process, even if you're not. You said, John, I am not. I know you're a CPA head. I'm not. Well, we're still going to have people from Moss Adams come and speak about the career in accounting and that kind of thing. So I think you'll benefit from it. And so I'd really like to see you there. Okay. All right, guys, let me shut up and let you get on with your day here and be looking for the practice midterm pretty soon. Okay. All right. Thanks, guys. Have a good rest of the day.